What exactly is 2024 cooking? We're barely into the second month, and it's already pretty obvious that the year is going to be challenging for the job market.
It's a tougher world out there in a great many businesses.
Firms are providing smaller raises to old staff and reducing starting salaries for new hires. But as if that wasn't enough, these companies now demand more from their staff. A crisis is in our hands, and make no mistake, this will affect everyone. But guess what? It's been a long time coming. Like a thief creeping in the dark, this has been a problem brewing for years. A problem that the Federal Reserve Bank and the government have ignored for years despite actually being responsible for it. Remember when the Fed printed loads of cash to offset the effects of the pandemic? Lots of the money went to unemployment checks, others to businesses, loans, and all other kinds of stuff. What happened next was amazing. With money falling from the sky, companies began to see record sales, leading to a boom in the economy. But here's where things get interesting. With enough money to go around, firms began to expand, leading to a massive trend in hiring new staff, which in turn substantially reduced unemployment rates. But pay close attention, because this led to a crazy domino effect. With companies needing to expand, they had to offer more to worthy prospects to beat the competition that wanted them as well. And that led to one of the fastest income hikes in American history. Sounds amazing on paper, right? Well, not quite. When this free money began to freeze in 2022, the COVID relief programs halted, and the Federal Reserve began to raise interest rates, making it even harder to get a loan. The infamous icing on the cake? Companies trimmed their staff to save on salary costs. In any case, it's not looking good, guys. With unemployment expected to rise to around 4.1% this year, 2024 is already shaping up to echo Warren Buffett's iconic quote, "If you don't find a way to make money while you sleep, you will work until you die." Take for instance that you're a worker with Citigroup, one of the biggest banks in the world. As a result of a very disappointing Q4 in 2023, did you know that the company has already decided to save billions by cutting about 20,000 roles over the next 3 years? That being said, it's not all doom and gloom. Despite being a part of the elite, Warren Buffett has never shied away from telling us the truth.
Who's winning? Wall Street? Main Street?
The extreme rich are clearly winning.
Right now, he's the 6th richest person in the world, with a net worth of over $128 billion. But given how billionaires make even more money during harsher economic climates, we wouldn't be surprised if the Oracle of Omaha goes a few places up in the pecking order when things get better. But what does this mean for the average Joe, you may ask? Well, don't worry guys, because we're going to tell you how you can make the current situation work in your favor and maximize your earnings. But make sure you pay close attention to the end, as every chapter in today's video works closely together. You can't afford to miss anything. First, let's address the elephant in the room. What exactly is wrong with the job market and the economy right now? As we mentioned earlier, one of the chief reasons why our economy is starting to shift so much is the interest rate hikes that the Reserve Bank put in place to cool down previous inflation problems. But as expenditures increase and new money is introduced, both individuals and businesses find themselves with more financial resources. This injection of funds propels economic activity, leading to a state of widespread consumer spending and business expansion. But of course, it comes with a lot of consequences. With an influx of money into the economy and increased spending from individuals and businesses happening simultaneously, demand sadly outpaced the available supply of goods, consequently leading to a surge in prices. It's basic economics. So now, to fight the inflation caused by pumping loads of money behind the scenes, the Fed had to make money more expensive by raising interest rates. But again, this is only a temporary fix. Leading economists will argue that it takes around 12 to 18 months to really feel the impact of an interest rate hike. But so far, it's already proven to be a big pain in the rear. Buying a car has become more expensive. Real estate prices have become more expensive. And don't even get us started on how crazy credit card debt has become. But it's more than just people being affected. Even companies are facing the consequences. To start with, it now costs significantly more to borrow money. And secondly, it's a crazy climate for businesses that are sitting on debt. For these businesses, the impact of rising interest rates becomes significant, especially with short-term corporate debt. Unlike a fixed-rate mortgage, Corporate debt often has shorter terms, like 5 years. So if a company borrows a substantial amount at a lower rate, when the debt readjusts, it might face higher interest payments due to increased interest rates, affecting their overall financial burden. But speaking of corporate debt readjustment, 2024 and even 2025 will have a snowball effect here. While the former will start the trend, the latter will see an even higher wave. And that's why many businesses are sitting in the corner with their blanket between their teeth, shaking in fear. Because if the interest rates remain so high, their interest payments will only get bigger and bigger. Can you finally see why everyone, including the Federal Reserve Bank, has openly stated that unemployment will rise in 2024? Now, it's a far cry from 2020 and 2021, when so many businesses either readjusted their debt or took on a whole lot of debt due to how interest rates were low at that time. Funny enough, though, a rise in unemployment could actually be a good thing. In a surprising twist, the tightening of earning power can have a surprising influence on affordability. When people face reduced income, their purchasing capacity diminishes, leading to a decline in demands for goods and services. This faltering demand, somewhat counterintuitively, exerts downward pressure on prices. Skeptical? Well, think about it this way. When wallets tighten, consumers become more discerning in their spending choices, opting for essentials over luxuries. This shift in consumer behavior prompts businesses to recalibrate pricing strategies to remain competitive. In response to the decreased demand, suppliers may choose to lower prices or offer more affordable alternatives to retain market share. Furthermore, reduced demand triggers a ripple effect throughout the supply chain. As businesses grapple with excess inventory due to lower sales, they may resort to price reductions to clear stock. This cyclical mechanism creates a market environment where affordability becomes a key consideration for businesses striving to stay afloat amidst diminished consumer spending power. So that's why the Federal Reserve Bank is probably hoping unemployment rises. All things being equal, the economy may just cool down a bit. Nevertheless, let's change gears a bit and look at the big changes we will see from employers in 2024. Guys, it's almost common knowledge that businesses are now grappling with the repercussions of increased costs. To start with, most of them are overburdened with a lot of staff that they can't all afford to pay back in wages and salary. The solution? To offset these financial challenges caused by a rise in corporation costs, businesses will require heightened productivity from employers, driving innovation, streamlining processes, and maximizing output to ensure their sustainability and competitiveness in the face of escalating operational expenditures. Then, there's also the simple solution in the form of massive layoffs, a measure that companies like Citigroup are already implementing. But that's not the only problem here. Companies are also worried about slower sales. Why, you may ask? Because a lot of consumers won't be able to afford luxury anymore. When the going gets tough, customers will gravitate towards only getting their needs instead of their wants. And that's bad news for a lot of companies. We already saw household debt and even credit card debt reach record levels last year. Many Americans are feeling the impacts of high inflation and the higher costs of living. And many will soon no longer be able to continue spending at the same rate as they were before. In such a scenario, businesses face reduced capacity to sell goods as consumers may reach their purchasing limits. This potential decline in consumer spending poses a threat to sales. Consequently, the push for higher productivity becomes more evident, with many companies expected to emphasize this strategy in 2024. This is why there is a growing trend among companies to encourage a return to the office, particularly in 2024. The aim is to enhance the productivity and revenue generated by each employee, serving as justification for their positions, divisions, and overall organizational growth. Remember when Google publicly talked about how they need more productivity out of all their employees in 2022? They demanded up to a 20% increase. So, let's say you were working at Google, for instance, when they wanted that surge. If you fail to meet the benchmark, there's a chance that your position and job will be taken away from you. And yeah, there's hardly anything you'll be able to do about it. Personally, we like the case of Citigroup because it's even more sneakier. You see, in a bid to make the company a much more effective and productive organization, they told hundreds of thousands of their employees to work from home at the end of December. On paper, this was to promote family bonding and give employees enough time to chill with their loved ones during the festivities. But beyond the surface, it was a crazy plan. The management took it as an opportunity to analyze their staff by seeing how productive they were. Those who failed to satisfy them could be laid off, and those who remained will be further screened to determine how much productivity they'll want to establish. But this brings us to the burning question. What does the paradigm shift in the job market mean for you? Having already established that companies will want the strongest and most productive staff retained in the company, while sieving the fluff, this only means that you will have to seize the initiative, and fast. Back when the economy was booming with massive employment and staggering wage growth, a lot of new employees didn't have to do much to gain a job. Even the old staff didn't necessarily have to work too hard. They could just have hidden under the shadow of overachievers in the company. Funny enough, that same period saw a phenomenon we'd like to call the Great Resignation. Employees were arguably more powerful than their employers due to the leverage and flexibility they had. If they don't like the terms, they'll leave in a heartbeat. But nevertheless, as we're starting to see a change in the economy and a slowdown, employees won't be able to afford that luxury. The shift has now brought power back into the hands of the employers, and that's why they can boldly demand more results, productivity, and efficiency. But hey, it's still good news for some of us, right? If you're dedicated and committed to giving your best at work, you can expect increased opportunities, salary raises, and career growth. The shift will only come as a pain in the rear for those who don't want to demand more from themselves. It brings more meaning to this iconic question from Warren Buffett. A rising tide floats all boats. Only when the tide goes out do you discover who's been swimming naked. So then, how can we improve our productivity? If you're not already a hard worker right now, turning a new leaf might prove difficult. But still, it's not impossible. Remember when Warren Buffett said, investing in yourself is the best investment you can make?
Most people go through life using up a very, very small part of their potential. And so anything you do that invests in yourself, that's the best investment you can possibly make.
Honing your skills is a crucial cornerstone for individual growth within a company. You've got to actively seek opportunities to enhance your skills, improve your resume, and prove to your employers that you have a lot of value. Because when the chopping block comes, only those who give value will be safe. But this can only work through continuous learning. Gain fresh perspectives, methods, and innovative solutions that will make the company progress. The final piece of the puzzle will then be to ensure all of your individual efforts align seamlessly with the organizational objectives. When personal and professional goals converge, this creates cohesion, a heightened sense of purpose, and an intrinsic motivation and commitment to the company's success. However, even with skill development, continuous learning, and goal alignment, true productivity flourishes when individuals work in companies they're passionate about. A genuine passion for the work elevates motivation, transforming tasks into fulfilling endeavors. And that's why Warren Buffett always said, "In the world of business, the people who are the most successful are those who are doing what they love."